Hi, Dr. D. Dr. Chanches?
Hi, this is Siraj. I'm here.
Hi, Saraj. Sorry, man. I just got a message from Mr. Karim. They will join shortly. They are finalizing in the NCOP now.
Okay, we'll wait. Thanks. Thanks for letting us know.
Hello, Rashad.
Morning, afternoon.
Afternoon, all members and participants on the platform. PBO.
Good afternoon, Chairperson. Good afternoon to honorable members and colleagues in the platform.
Afternoon, sir.
Nkululeko?
Hello? Hi, Chair.
Students, gang.
Yes, Chair, I can hear you.
Yeah.
Come again, Chair?
Right. Everybody,
You keep cutting, Chairperson.
can you hear me?
I can hear you now.
Nkululeko and other. Oh
Yes.
dear, what do I do? Yeah. Am I okay now?
You're still cutting, Chair.
Okay, otherwise Njabi can take over chairing. Just very quickly, welcome to everybody, in particular, what to do.
The best thing you've said all year, Chair.
Recording in progress.
Hello.
Hi, Chair. Mr. Karim.
Yes, can you hear me now?
I can hear you now, sir.
Yeah, I'll switch to 4G away from the Wi-Fi. Maybe that'll help. All right, welcome everybody, in particular the PBO. Before we move on, any apologies, Nkululeko?
Yes, Chair. The only apology I received was from Mr. Muletsani.
Fine. Secondly, can members please note, and indeed PBO and others who are not connected to the committee as members, that these matters are beyond our control. Our late start, it's the NCOB program. We've engaged with the powers that be, but we're stuck till the end of this term. I'm not sure what we do, so I'll leave it there to the programming whips of all the parties to sort out. There's nothing we can do, so we apologize to PBO and others who joined us at 2:30 for this meeting. But it was the NCOP plenary and we had to be there. We have pleaded with them to bring back the committee meetings to 9 and 10 a.m., but we are where we are. Right, over then to the PBO. They've specifically requested a longer speaking time, normally 45 minutes, maximum an hour. They asked for an hour and 15 minutes. I said, fine, because, you know, there's two components of the work we're doing at the moment with the PBO and others. One is an educational one, meaning, you know, we're not here at a highfalutin master's course or PhD seminar. We are simple folk here, and many of us are new to Parliament altogether, and certainly the Finance Committee. And so we must use concepts in a simple, clear way, which does require of them more time. So apart from setting out more explicitly the issues that flowed from previous exchanges with both committees, NA and NCOP, it's difficult to meet because they're on constituency time already. will be here for 2 weeks beyond their ending last week, Friday. So here we are. They will both set out their perspectives on changes even within the IMF and World Bank and the multilateral institutions on how you manage your budgets and how you revive the economies given COVID. And an overall view, I think they have that there's a more state-led growth part, and monetary policy also needs to break away from its traditions until now as guided by the IMF, World Bank, and associated institutions. But they'll speak for themselves. For us, we need to acquire an understanding of the basic concepts, but also a better, firmer view of their views and bring this to bear in our exchanges of national treasury, so we're more vigorous and more rigorous in our oversight role. Over then to your team, Dumisani.
Thank you so much, Chairperson. Good afternoon to honorable members, and thank you for the opportunity for the Parliamentary Budget Office to brief the committee with regards to issues around economic development and economic growth. And certainly, Chairperson and honorable members, one of our 4 key fundamental principles is to really, make sure that our work is accessible to members of Parliament. It's very one of our fundamental roles in our goal, strategy going forward to make sure that our work is not very technical, very accessible. Thanks so much for highlighting that. We will endeavor to do that all the time. Chairperson, thank you so much. Once more, we will meet after an announcement of the Q1 economic news that GDP has grown 4.2% year-on-year, which is good news. And Chairperson, I'm with the team on the platform, Dr. Mohammed, Mr. Andra, and Mr. Simelani will do presentations. I'll do the introduction and give them to go through substantively and explain the concepts. But also, as I said, it's our goal to empower members with this information for their role as society in this regard. Before we go through the detailed slides, some of the few 1 or 2 comments I want to make also. I mean, the briefing or the discussion, Chair, members, is very well timed if you look at it. If you look at the extent of how many countries and multilateral institutions are currently, going through thinking and recognizing the importance of the role of state. The role of state has to play in economic development through macroeconomic stance, particularly looking at use of fiscal policy and other policies to really support economic growth and development in economies. But also in the macroeconomics literature, we have seen shift in thinking, which we'll go through in detail. From the mainstream views about the importance use of fiscal policy, not only in times of crisis, but also in leading a private sector in investing in economies. Technology and innovation, human development are some of the areas where many countries, I know also in January's United Nations Economic Outlook, they highlighted these areas as some of the key areas which would be likely supporting development, sustainable economic development going forward. So it's very important, and also citing the development of the COVID-19 vaccines, which was really government-led in support in the process of getting that. So it's a very good context we're going to be looking at in these aspects. Next slide. I think, Chairperson, our presentation really tried to give this context and also explain the concept and the role of government in economic development, but also sharing some of the experiences on what's been happening in the thinking and literature around how economic development and sustainable growth can be realized in the process. This is the outline. We'll go through the detail. Next slide. I think, in giving introduction, Chair and other members, I just want to highlight that some of the 2 concepts in economy that enables economic development, sustainable economic development, and growth are around, the human capital formation, how much the labor force, how much society is well equipped to deal with some of the developments, but also the need for industrial structural transformation, which are some of the concepts that we have to grapple with as a country in that context. And Chairperson and members will realize that And I agree that these concepts, these aspects are very much related, integrated with each other. Enhancement of one will definitely ensure the enhancement of the other, and broadly affecting the economy and creating much needed employment. It is important for the economy to create adequate jobs, learnings, as this influence the developmental indicators outcomes for the next medium term, long term in this regard. So in general, Chair, we find that there are large constraints on economic development and growth due to inadequate human development, economic and industrial transformation, food and energy, security and infrastructure, some of the key fundamental areas which really are dragging the economy down from growth. And the context that the evidence shows that inequality is certainly affected by lack of growth, lack of development, and it grows as those also drag down. And take into account the Washington Consensus forged in the 80s, which really supported the large role of market and the smaller role of the state in the economy, which when we look at the outcomes, this approach led to large increase in inequality and between countries, fiscal instability, crisis, growing up. We've seen some of these developments since these forged. There's also now concerns about the rise in network industries, securities around digitization, and also the growth in entrenchment of political police sectors that are very much dominant in the economies, which are always going to remain dominant. How do we break those? These raise concerns of the importance of having international cooperation and coordination, trying to deal with these issues of economic development growth, with also ensuring that our objectives are clearly spelled out. There is an emergence consensus that these problems cannot be solved without a large involvement of the state in dealing with some of the issues and the measures taken by the state to address poverty and inequality. Injustice and historical injustice will affect the human and economic development. So it's very important to take that as a holistic. Therefore, expenditure on state social support and infrastructure investment is necessary for economic and industrial development and will affect the size and performance of the economy. In turn, the size and performance of the economy affects the well-being of society as well. So I think it's a context that we set out for the conversation, Chair, honour members, and we'll keep on plugging some of these aspects during the discussion. Thank you so much. I'll give Mr. Amar to take us through the human development issues and then we'll take it forward. Thank you so much, Chair.
Good afternoon, members. Maybe it's Mr. Simelane. Mr. Amra will come after. I'll be okay. No, it's okay. I'll be looking into the human development indicators. We can move to the next slide, Siraj. I'll try to be slow, and I'll also try to explain some of the concepts so that we all move together. So Human Development Index is a measure of the average achievement in the key dimension of the human development. So these three key dimensions are health dimension, which is measured in terms of the life expectancy. The second dimension is education, which is also measured in terms of the years and the years of spent in education. And the third dimension speaks to the standard of living. So those three key dimensions, they will give the indicator or the human development indicator. And the range of the human development indicator ranges from 0 to 1. So the 0 indicator, it means the development in the country is very poor. And in the index, there is 1. That means the development in that country is very good. So in the South African context, the index is 0.71. And South Africa is ranked number 114 out of 189 countries. So that is the human development indicator. But looking or taking into account the inequalities within those three dimensions, which was introduced in 2010, the UNDP introduced in 2010, the HDI, which is the Inequality Adjusted Development Human Indicator. Now we see that the value, it decreases to 0.468. We can move to the next slide. The next slide look into the first dimension of the HDI, which is education or striving for, which is health, which is striving for long and healthy life. One of the key or the most important indicator is the life expectancy. So if we look into the first two diagram or the first two charts, the upper left, the top left, and the bottom left also, we see that the life expectancy of South Africans was 63 in the year 1990, which dropped into 53 years in the year 2005. And we look into the below chart, which is a child mortality per 1,000 live birth. It increased from 59 into 78 in the year 2005. So this, the reason or the cited reason for the drop in the life expectancy was the infectious diseases that has to do with the HIV and AIDS and the other communicable diseases. So that's why we saw the life expectancy decreases to that very low. But after then, it has increased into 64 years, which is in the latest, the 2019. The other diagrams speak to the malnutrition, and the lower the value of those diagram or of those lines, that means the country is doing well in terms of addressing the issues that has to do with the nutrition, or the increasing value of that diagram, it means the country is not really doing well in terms of addressing those issues that has to do with the malnutrition. We can move to the next slide. The second key dimension of the Human Development Index speaks to the education or the access into education. It is measured using the expected years of schooling and the mean years of schooling. So we see that the expected years of schooling and the mean years of schooling has been increasing from the year 1990 to 2019. So what does the increase in the mean year of schooling means? It means people are spending more time in education, or there is less rate of dropout. Maybe people are no longer leaving school at the primary level or at the secondary school level, but they are furthering their education. Or there are more people who are learned, there are more people who are acquiring educational degrees. And it's a good thing because they tend to earn better, they tend to have stable job and all those kind of benefits. So the South Africa has improved in that area in terms of achieving the second dimension of the Human Development Index. We can move to the next slide. The next slide speaks to the poverty level in South Africa. It is measured by taking the multi-dimensional poverty index. The multi-dimensional poverty index, it measures the acute deprivation in health, it measures the acute deprivation in education, and also into standard of living. So combining all those deprivation in those three key dimensions, it will give us the multi-dimensional poverty levels in South Africa. So we see currently, or in 2019, it was 0.025. And the range of this index ranges from 0 to 1. So if that index is high, that means there is high level of poverty. And if the index is low, that shows that there is a low level of poverty. In 2019, there was 6.3 people or population, or in terms of the head count, which were in the poverty, multidimensional poverty level, or about 3.8 million of people were in that level. And this graph just shows the numbers, how it has changed over time. People living in $1.9 per day, or the poverty gaps as well. So the trends, we see that it was going down from the year 2000 until 2008 or 2010. So there were some improvement in terms of number of people who were below the poverty lines, or the poverty gap was being reduced. But from 2010 going forward, then we see that the numbers have started to be not good or to worsen up. We can move to the next slide. The next slide speaks to the inequality level in South Africa. So in terms of the inequality level, we look into a human inequality coefficient. which measures, or it's an average measure of the inequalities in the 3 dimensions. The 3 dimension is health, is education, and the standard of living measures in terms of income, or in terms of the gross national income per capita. So that coefficient in the top left corner, it measures the coefficient of the human inequality. And we see that maybe the range, it ranges from 0 to 1, 0 being a inequality. If it's 0, it means there is 0 inequality, or there's less inequality, and it's good for the country. But if the coefficient increases, that means there's high level of inequality. So in that case, if we look into the year 2014, the index there was 33, which it can be 1 to 100, or it can be 0 to 1, or it can be 1% in 200%. So in this case, its numbers ranges from 1 to 100. In the year 2014, it was 33, and it has improved into 31.2 in 2019. That is an improvement of the human inequality. But when we adjust that index into the Human Development Index, taking into account the inequalities, now we see that the top right diagram, there is an increase in the Human Development Index. That means there was the inequality level we're reducing looking at the coefficient, which improved the inequality adjusted Human Development Index on the right top corner diagram. We can move to the next slide. The next slide speaks to the service delivery. We maybe just to look into one diagram, the top right diagram, it speaks to the main sources of energy used for cooking in South Africa. In the year 2002, the electricity, there were about 60% of the population who said they used electricity for cooking as a main source. But going forward into 2019, we see that has increased. So that means there are more people who are relying on electricity as a means of cooking. We can move to the next slide. Thank you. I will hand over to my colleague who will do the economic restructuring, this transformation. Thank you so much.
Okay. Thank you, Chair. Honorable members, thank you, Siphatelo. I'm going to be looking at the slides dealing with economic structuring and industrial transformation. And just on the previous slides that Siphatelo presented, I do want to say that a lot of the data available is sort of only up to 2019, and in some cases beyond that. But we do know that poverty, inequality, unemployment increased last year as a result of the COVID crisis. And so we should keep that in mind. The other thing that I do want to get us to think about, because we often speak about it and we use the term all too often, we talk about inequality, and it sort of comes across as kind of an abstract notion. But within Siphatelo's slides, I don't know if you noticed, there was something that referred to the Palmer Index, which looks at it's a ratio of comparing the top 10% in terms of incomes or in terms of expenditure, sometimes in terms of wealth, to the incomes of the bottom 40%. And so that's what the index is. And we see in South Africa that for the year that Siphatelo referred to, I think it was 2015, but it's probably gotten a bit worse, that the households in the top 10% of by expenditure, so people with the most wealth and income in South Africa, by the top 10%, were spending 8 times more on consumption, on buying groceries and other things, cars, etc., consumables, 8 times more than the whole of the bottom 40%. Now that's really hard to get your head around, and it's something to think about, because as we talk about the structure of the economy, what is shaping the economy, what has shaped the economy. Economies are path dependent, so what happened before shapes what happens today, and what happened before and today shapes the future and the outcomes. And if you think about that level of inequality, who's got the buying power? We often use the term, the customer is king. It's a gendered term, I know, but that's what a lot of us grew up hearing. And this notion, if you think about in South Africa, that top 10% is basically the king, in a sense, in terms of what they buy, how much of the things produced in the economy, the demand for imports, a lot of import leakages, more luxury products, and in fact, a lot of them, especially if you look at the top 1%, would actually not be spending and consuming a large part of the incomes, but saving it, moving a lot of it into offshore accounts. A lot of us get, I'm not part of that top 1%, but a lot of people get messages in the newspapers, emails about offshore accounts and offshore banking, Jersey Island. I'm sure you've all seen that. And so we need to think about what this inequality means for the economy and the constraint that level of inequality puts on it. We've seen recently the head of the IMF, people, the OECD, in the US economy, all flagging inequality. These are countries with much lower levels of inequality than we do, but saying that it has a real impact on the social fabric, on the productivity in the economy, on the politics in the economy. And so we have to, I think that has to be our starting point for thinking about it, and not think about inequality just as this kind of abstract notion, this term that we hear a lot and we've become fairly desensitized to. I'm trying to change the slide now. Okay, here we go. Now, to start off with, the question that was initially put to the PBO was to look at constraints to GDP, and very quickly we changed that to looking at development. And one of the reasons is that GDP, and as you saw from my colleague before, the slides he presented on the Human Development Index, the Multi-Poverty Development Index, there are much better ways to consider the health and the welfare and what's happening in an economy. And GDP is presented as an objective measure, but it's actually a socially constructed measure and indicates certain views on what is productive and what should be classified as the economy. And so, a lot of us, the way we do our budgets, the way we think about levels of debt that are permissible in the economy, all kinds of things are based on this number. But this number is a number that has been developed by people. There's now a system of national accounting where there's an agreement across countries about and recommendations about how you should measure GDP and report it, etc., what should be included. But it still is, and it's something that changes over time, as I'll show you in the next slide. And so within this notion is that economic growth is anything that causes a positive change to a country's GDP, usually measured in terms of value added. However, the cause of this change may not be good for the economy. The one thing we always talk about when we teach is pollution. Pollution is spoken about as something harmful to the economy, and we refer to it as externality. It's not often included in the costs of businesses, and it's not included in the costs that are reflected in GDP. So these are unmeasured, but there are many other things that are harmful. The relationships to people, the labor relations within workplaces, the activities in the financial sector and predatory behavior or overcharging of fees, etc., which we don't actually take into consideration. Many activities that have a positive impact on society are not measured in GDP as well, and therefore undervalued. And here women's work and women's labor, where they carry a disproportional load, is included in that, including things like unpaid housework, including cooking and cleaning, care for the young, sick and aged, community building and support, and aspects of public and charitable health and education, and other services are not included. That work, that value added. So if you think about cooking at home, say I cook a meal at home, I've got input costs from the ingredients. I've got, say, electricity or gas. I've capital equipment, pots, pans, etc. All of that is used to add value to the ingredients I use. But if I feed my family with that food, it's not counted towards GDP. If I did that same activity within a restaurant or takeaways, and I sold that food, it would be included in GDP, and it would be included under services, the tertiary economy, under catering and accommodation services, where we measure that. But if I had done that cooking and then packaged it in a way that it could be sold, say, to a wholesaler and then to a supermarket, it would be classified as manufacturing, because I am actually in the process of cooking, manufacturing an output, manufacturing food. And so you see that what is measured in GDP and where it's measured and how it's measured is also something that needs to be considered. And it's, we often just talk about GDP, again, in these kind of abstract terms and believe the numbers and say that, and base a lot of our policy decisions, like spending, like debt levels, on that one number. Now, I wanted to talk more about GDP and finance, because I'll be coming back to finance, and finance is really important if we talk about constraints to growth, especially in terms of thinking about the structure of the economy and how to improve the structure of the economy, make it more inclusive, make it, it's important to think about finance, about money for investment. Where does that money come from? Who has that money? Are the banks and the financial institutions like pension funds, institutional investors, and others who have access to that capital, are they putting it into investing, especially in the productive parts of the economy where we create jobs, add more value, etc. So the system of national accounts, which is, as I said, this agreed upon national system of how countries should go about and recommendations on how they should collect their GDP data, included finance, which was previously deemed unproductive and in many cases a cost of production. So that's, for me, that was really interesting because, if you look at it, we can actually think about finance more as a cost and adding value to processes. But if we start looking at from the 1930s, banking fee revenue was reclassified, and so finance was included in GDP as adding value towards the economy and economic growth. In 1953, especially we see we have more welfare states, more Keynesian thinking about the economy. The system of national accounts saw most finance contribution as negligible and even negative to the economy. And these are people who were still remembering the impacts of the Great Depression of the 1930s. And the negative impacts that finance and banking had on the economies then. But by 1968, the interest payments were reclassified from unproductive to productive, and even though financial fees and costs do reduce incomes available for the purchase of productive value-adding goods, they were included as value added, and the banks were seen as value-adding agents within the system of national accounts and in GDP. And this is important because if we look at not only Africa but many other countries in the world, the contribution of finance, the services sector, but particularly finance within the services sector, to value added has grown a lot. I read an article, I think a few years ago, where they actually argued that one of the reasons for the changes in the 1960s was that the US was becoming less productive and less competitive in manufacturing, and lobbied for the changes so that finance and within America from the late 60s, but particularly in the 70s and 80s, you saw more financial liberalization, a larger role for the banks and financial institutions. And so the economy could appear larger and the largest in the world relative to other economies by including finance more. Now, linked to also the role of finance is that predatory finance and activities that increase systemic risk are negative for GDP and economic development. So even if we are seeing more value added, it could be related to those kinds of activities. The example that comes to mind immediately is sort of the way in which the banks and other financial institutions supported the proliferation of subprime loans, particularly to people of color in the U.S. The FBI and others did research into this and found that even if people qualified for prime loans, because banks could make more fees and make more money on subprime loans, they pushed that onto people, and then these loans were securitized. And this led to the problems that ultimately led to the subprime crash and the global financial crisis of 2008 and onwards. If we think about South Africa's economic growth in the period leading up to the global financial crisis, say from 2003 to 2008, it was relatively high, but it wasn't sustainable because it was driven by increased commodity prices, growth in finance, and here we saw a lot more financial speculation. We saw the stock market indices increase significantly in a very short time. And we saw debt-driven consumption growing hugely, went up to over 80% household debt to disposable income. And there was a real estate bubble. I remember in 2006 when I returned from the US to take up a job at Wits, that in 2004 and 5, house prices in South Africa almost doubled in those 2 years, increased by 100% in many of the housing markets. Growth was also increased by public infrastructure investments for the 2010 World Cup and to deal with backlogs. And what was clear to many of us, but it didn't seem to be clear to many governments, including our National Treasury government departments, that growth could not return to the pre-crisis level in 2003 to 8 levels after the crisis. But in fact, there seemed to be planning and this idea that GDP would return to those levels, and if one looks at the forecasts in that period. And so a lot of the planning and the budgeting was done with that in mind. And to some extent, I believe that our debt to GDP level increases now and are based on some of those kind of assumptions and notions that there would be this bounce back. Now, talking about structural transformation requires industrial change that builds and increases economic activity from sectors of low to high productivity and complexity, but it also deepens industrialization through upgrading from low to high productivity activities within economic sectors. So even we can think about, say, primary sectors like agriculture. We see with you can transform an economy through with most value added in primary sectors such as mining and agriculture towards increasing value added from manufacturing, and then onto advanced industries that combine high value services, increased research and development and manufacturing. And a lot of agriculture now, for instance, has become very increasingly mechanized, research and development, the use of advanced chemicals, advanced machinery, and lots of science, genetic modification, those kind of things. Now, evidence shows that economic development is associated with increasing the size of the economy. GDP growth leads to a larger tax base that in turn could support increased provision and quality of social services. It is also associated with employment and incentives that promote higher levels. Manufacturing is considered key to structural economic transformation because it has strong linkages across entire value chains from the primary sector such as mining and agriculture through to advanced services, engineering and design. Now, a lot of people think that this notion of manufacturing is outdated now, especially with talk of the fourth industrial revolution and the growth of ITC, information technology and communications industries. But we see that especially from experiences in East Asia, China, some parts of the South Asian continent, states in India, that manufacturing, the experience, it still is central to that as a kind of think about it as an engine of growth. And historical evidence shows that development of manufacturing has the ability to drive technology-dependent productivity of other economic sectors within value chains. For example, productivity has increased in agriculture with advances in manufacture of agricultural machinery, chemical fertilizers, genetic engineering. If you think about other manufactured products, South Africa's had one of the areas of more advanced manufacturing where we've had some successes in the last 2 decades have been in the auto sector. We've had an industrial policy, an active industrial policy to promote that sector. And we find that the chemicals and plastic sectors have developed as a result of that, as driven by the demand for inputs and more technologically value-added inputs. They need things like glass and the technology over the last 3-4 decades for windscreens and used in cars, even mirrors, and then the electronics, and pushing for increased local production, local content within those kind of sectors as part of support for an industrial policy does help provide for some of those advancements. But the problem that I think is generally agreed, and we see it in the outputs from the DTIC, things like the last Industrial Policy Action Plan, etc., that South Africa has not achieved significant transformation and is in fact prematurely deindustrialized. There have been large losses of employment in manufacturing, particularly due to declining diversity in sectors that would support fast employment growth directly and in associated services sectors. While certain services sectors, particularly finance, have grown, South Africa's role in global value chains has generally remained that of providing low value-added primary products and raw materials. South Africa continues to remain dependent on mining and minerals for much of its export earnings. So we're going to have a few graphs that will provide the evidence for what some of those points that was just made. Here we're looking at employment and say that there have been job losses in productive sectors such as manufacturing, mining, quarrying, and agriculture, forestry, and fishing. If you look at the top graph, it shows for periods of 5 years, 2000, 2005, 2010, 2015. I've included 2019 because 2020 was such a big year for job losses, so that it didn't seem to distort the data. But if you look at manufacturing, the declines already start in 2005. Agriculture, forestry, and fishing, we see the large declines in employment. Mining and quarrying from 2010, we're seeing a decline in numbers. But we can also see the relative amounts of people. Now, what we did see in the period leading up to the global financial crisis, particularly large increases in employment in wholesale and retail trade, catering and accommodation services. But a lot of those jobs were actually more in wholesale and retail trade services. The jobs in catering and accommodation, even though tourism has grown, were quite flat. And one of the reasons for that is that if you look at the finance, intermediation, insurance, real estate, and business services, which is the second group of columns, you can read it as FIRE BS. If we disaggregate business services from finance, insurance, and real estate, we see that lots of those job increases were actually there, and not in finance and insurance. So the graph below shows employment in selected sectors, and there we've got finance and insurance, and you can see from 93 through to 2019 that there was growth, especially after 2009, 2010, but it levels off by 2017. We see manufacturing jobs declining over the period, even though there was a slight increase linked to debt-driven consumption at the time before the global financial crisis, but then it comes down again and it sort of settles at around about 1.5 million. But we do see a big growth in what's called business services activity not elsewhere classified. And a lot of that is outsourced cleaning services. And one of it was outsourced cleaning services to hotels and restaurants and others. And so I was talking about most of those jobs in wholesale and retail trade were not actually in tourism, catering and accommodation, but in basically fairly low-paying jobs, casualized jobs, sometimes informal sector jobs in wholesale and retail trade services, and so a lot of our service sector jobs weren't actually very good jobs, often not sustainable jobs, because some of them grew at the time of the crisis. Actually can't see the title of this on my graph.
It
here.
says sector value added contributions to
second.
GDP in millions, 2010.
Okay, so here we see value added in the sectors, and we see that manufacturing actually does increase over time and decreases by 2020, but that a lot of what's happening in the economy is not in high value added sectors. And so let me move on to sort of talking about investment. And instead of showing the gross fixed capital formation numbers, I thought I'd talk about capital stock, which is the stock of capital and equipment and buildings and things used in production processes and in businesses, and gives one a sense of what the capacity for the economy to do things. So it's a stock built up by investments over time. And we do see, again, the finance, insurance, real estate, business services, capital stock increasing and being the most. If you look at mining and quarrying, it does increase because mining and quarrying is a very capital intensive sector, and it uses up the capital equipment very fast. And in fact, we have tax incentives supporting that industry, rapid write down of capital equipment because of that. We see in manufacturing, though, that capital stock has declined over time. So what we have less capacity to produce in manufacturing than before, and these are real numbers. Based on 2010 rands, and so over time we see a real decline. And if you look at agriculture, forestry, and fishing, and what's interesting is that even though we saw the large increases in employment, in wholesale, retail, and trade accommodation and catering and accommodation, we don't see huge increases in capital stock in that sector. The graph below shows a comparison of capital stock and value added in the percentage change, real change from 2000 to 2010. And so what's interesting here, we see the value added in the finance, insurance, real estate, business services sector increasing the most of all the sectors, but the capital stock not increasing as much, but fairly large, relatively speaking, increases. Construction, obviously, we would see capital stock increasing a lot, and value added also in that sector. But moving on to manufacturing, we see that value added increases by 20%, but there was a decline in the capital stock by almost 10%. So what's happening here is we're basically not investing adequately to keep our capital stock at the same level in real terms over time, even though the economy has grown, even though in real terms GDP has grown. We're not seeing that, even though the population has grown. And that 20% in value added sort of comes to, over that 21-year period, to less than 1% a year increase in value added, and that's coming off what's now fairly old capital stock as well. In mining quarrying, as I said, it is quite a capital intensive sector, so we do see increases in capital stock over time, but we actually see negative value added, and so that is quite worrying, and especially now as we may be going into a commodity super cycle in with increased demand, hopefully that does pan out and it helps us increase our GDP. But we actually may not see the value added necessary there. Now, these are the next slides show exports, and I'll talk about this more quickly because I've taken quite a bit of time sort of trying to give people a sense of the structure of the economy in terms of value added, capital stock, etc., employment. But the exports give us a sense of not only our competitiveness, but where we fit in the kind of global division of labor. And has that changed over time? Have we had a structural change in the economy to do that? And the top graph shows the shares of different sectors. And we see that mining over that long period shown has basically stayed sort of between the 50-60% range. About 50% of our exports are mining. But if you look at the graph below, that sort of gives a breakdown of the subsectors of manufacturing exports. We see that, for instance, in 2015 and 2020, 40% of our exports were in metals, metal products, machine and equipment. And in fact, most of those exports weren't machine and equipment, they were metals and metal products. So basically very closely linked and sometimes even produced at, right at the location where things are mined. Almost like a sort of fairly close to the mining sector in a sense. And so we are dependent on fairly on raw material exports and fairly low value added beneficiated mining and metal products for a huge amount of our exports, even though the economy's had growth in certain kinds of services sectors like finance. The second big section of our exports were wood, paper, publishing and printing, and a lot of that, in fact, South Africa's had the decline in the value added in that sector since the 1990s, and a lot of those exports are now wood chips and paper pulp and low value added again, and linked to that kind of job losses in the more value added parts of the sectors. And the same goes for machine and equipment, especially in our mining capital equipment sectors. And I don't have time to go into that in detail now, but we've actually, being one of the forerunners in the world with the offshore listings of companies, with the breakup and restructuring of the large conglomerates, we've actually lost and some of that capabilities moved abroad. In terms of thinking about the concentration levels of the economy and investment, this is really important. And I try and sort of give some background here that the concentration of markets and the role and actions of large corporations is critical to understanding the poor levels of fixed investment in South Africa. The roots of very high level of concentration of the South African economy lie in the development and growth of the mining and mineral sector in South Africa and the formation of mining finance houses over a long period of our history. Jumping to the 1980s, South African big business followed the trend in the 1980s in the US and some other developed countries to build large diversified conglomerates. However, this further concentration in the economy through this growth in diversified conglomerates occurred in a much smaller South African economy. And so we had what I refer to below as extreme concentration. The liberalization of finance during the 1980s, the apartheid government sort of tried to increase financial flows and liberalize finance, gave the life assurers and institutional investors more space to invest. But this process supported the conglomeration, which was aided by large life assurers and other institutional investors. Large corporations also bought up the subsidiaries of companies that divested due to pressure from the anti-apartheid movement. So this further increased the concentration. The result of this extreme market power was that the conglomerates could behave in a predatory manner to buy out or squeeze out competition. These conglomerates also colluded and divided up markets and the economy amongst themselves. Extreme concentration remains one of SA's greatest challenges. And the work of the Competition Commission on the post-apartheid period, and we've had a significant unbundling of many of these large conglomerates. Some have listed offshore, some have been bought up by foreign companies and still have South African operations. But we still have a level of concentration, and many of the subsidiaries of the older companies are still at the forefront of the levels of concentration. And so we see that in South Africa, a lot of this profitability is linked to market power. The table on the left shows ROA, return on assets, and return on equity, and these are sort of 2017 numbers. We didn't have time to update to later numbers for this presentation, given the amount of time we had. But we're seeing fairly high returns on equity in consumer services, particularly communications, banks, insurance, mining. And some of that is oligopoly or monopoly power and the ability to extract those oligopoly monopoly rents. Studies show that there are dominant firms in 294 distinct product markets. The Stats South Africa and also academic researchers have sort of calculated concentration, and they use something called the Hirschman-Herfindahl index. And it shows highly concentrated sectors in South Africa in communication technologies, energy, financial services, food and agro-processing, infrastructure, construction, intermediate industrial products, mining, pharmaceuticals, transport. And the Competition Commission's work shows that concentration and vertical integration within sectors has increased since 1994, reinforced by high barriers to entry. Now, we also have a fairly concentrated financial sector. So we have both a concentrated non-financial sector and financial sectors. Means that investment finance is allocated towards existing dominant firms. A lot of the money that actually goes into investment is from retained earnings and also sometimes raised on the stock exchange. The banks in South Africa aren't big lenders to businesses for investment and expansion. The large firms use their market power to earn good profits, but investment remains weak. And I'll put up some graphs later to show that. And one example of this is the decline in manufacturing capital stock. So even though in certain manufacturing sectors we are seeing higher returns on assets and investment, but we're not seeing the investment. And in fact, as I said, manufacturing capital stock has declined. The post-apartheid government thought that financial liberalization would attract foreign direct investment to compete against South Africa's dominant large firms, but this FDI did not materialize at close to anticipated levels. And one of the reasons is that because there was so much market dominance by large corporations, the barriers to entry were high, and that many foreign investors stayed out of South Africa because they didn't want to compete in those markets and knew they would find it difficult. And in fact, where there was entry happened through agreements, either mergers and acquisitions or copyright agreements, licensing permits, etc. Foreign ownership of South Africa's of shares of South African firms have increased, and instead of having these large levels of FDI, many of South Africa's largest corporations, such as Anglo American, Esso Breweries, we can think about Investec, other firms restructured, moved their primary listings abroad or cross-listed. Today, a large share of the operations of many of these largest corporations are outside of South Africa, and I'll show that in a second. The application of competition laws to reduce market power has also not worked as required, and in the current context is clearly not enough. In fact, this push for sort of increased competition hasn't across the world in competition law hasn't actually led to less concentration in many economies, and in especially the East Asian development models, countries like Japan, South Korea and others, there was a dependence on large corporations actually to drive the Zaibatsu and the Chaibal, to drive the development of the industry and value added in those firms, in those countries. And the cooperation, and so to some extent there's sort of a relationship between the state and those companies where there was a lot of discipline by the state, but also reciprocal agreements where they received lots of benefits, including access to finance, control of imports through tariffs and active trade and industrial policies, etc. So to some extent, the large corporations can actually be part of increasing investment and industrial development and economy in South Africa. That hasn't happened. So what I'm arguing is that industrial policy aimed at economic transformation and diversification, combined with much higher levels of development finance directed towards higher value adding productive activities, is required. And we sort of ran out of space in a way to talk about development finance within this presentation, but the roles of development finance, especially in increasing productive investment in even in countries like Germany, is really important. State-owned banks provide a huge share of in countries like Brazil, India, Japan, in China, and as I said, Germany. And so development finance is a hugely important need for industrialization. Now, in terms of capital flows and international finance, I spoke about not enough FDI, but an increase in foreign foreign ownership on the stock exchange, and a lot of that is through short-term portfolio flows. But we've also seen an increase in net other investment, which is linked to a lot of, in my view, is linked to increased carry trade, where people borrow in one country where interest rates are low, put that money in South Africa, get a quick short return on the high interest rates, and then move that money back into their own currency again, or into their own countries. Sometimes they don't even have to do the currency conversions. But what we see in the graph on the left is that we have had, over the period, most of the flows, these are net flows, so inflows minus outflows, have been in portfolio and net other investment flows rather than FDI. There has been periods where FDI has spiked, and in fact that direct investment has spiked, especially when there's been like the 2001 crisis, where we saw the Rand, basically a currency crisis in South Africa. The Rand dropped a lot, the stock market crashed, but we did see FDI increasing there. We see 2008, again FDI increasing when portfolio flows crashed. Also in the earlier period, 1997, 2001, where FDI increase, it's linked to the offshore listings, where the shares of the ownership of shares of companies that were South African become foreign ownership. and those were FDI basically. So it's a paper transaction. I can talk about this much more, but I'll move on. But so just to move to the bullet points, there's been a large grudging shift in mainstream views, and this is also in the OECD, in the World Bank and IMF, in their literature, that capital controls can be effective, can limit the destabilizing impacts of short-term financial flows on the economy. And short-term financial flows, if you think about portfolio flows, they come into a country for a short period of time, but what they do is, if they're absorbed into the economy, like if we look at what's happened in South Africa in the period leading up to the global financial crisis, say from 2003 to 2007, you look at the red line in the left graph, you see that sharp increase in short-term flows going almost up to 8% of GDP. That money gets absorbed into the economy, increases the availability of debt. It leads to, but it also pushes up stock prices, so you get more speculation in financial markets, you get more debt-driven consumption, You get more speculation in real estate assets as well. And so it drives those kind of speculative activities and increased long-term household debt that increases systemic risk in the country. And if it moves out and crashes, it has a big impact on your currency, but also can leave many people with financial problems and increases basically the macroeconomic fragility. So there is a view and a strong view, especially since the Asian financial crisis reinforced after the global financial crisis, that countries should look at using capital controls, especially to control short-term flows. But South Africa has continued to liberalize financial flows and in fact offered a second amnesty to residents with money outside of the country illegally. So even if this policy led to more inflows of capital, it was not associated with more and better investment. Most net inflows have been short-term and net FDI has been very small compared to the short-term flows. South Africa's economic growth path has been affected by financial liberalization and the type of financial flows crossing the country's borders. And what I showed you, for instance, in the period before the global financial crisis on the left and the impact that those large inflows had on the economy, has sort of drove investment into the financial sector, into construction and real estate, into wholesale and retail trade, and to some extent diverted money away from other manufacturing and other sectors, and so affected the growth path in that way. But it also affected the growth path if we looked at the balance of payments. On the right, we look at the current account. So the left is the financial flows, that side of the balance of payments. The right is the current account. Now, lots of people think about the current account just in terms of the trade balance. But a lot of the flows, especially in South Africa, since the period before the global financial crisis, have been linked to financial flows where foreigners buy more shares in your economy, have more financial interest, and more profits and dividends earnings are repatriated. So we're seeing, if you look at the red line, it's the balance on the current account, which is the total balance on the current account, and the right is the trade balance. And if we look at the period, we actually see that the current account outflows and most of it is linked to financial transfers. And this is a problem because in South Africa, if once GDP takes off and people start investing, whether it's in mining or in manufacturing or in finance, a lot of that capital equipment has to be imported. And if you read the GEAR document and even the 2019 document that Treasury brought out on the need for structural reform.
Siraj,
yes?
Just to let PBO know, you must decide to manage your time, but
okay.
You're at an hour at the moment. You've got 15 minutes left. Yeah.
Okay, I'll talk faster then. I've been going into too much detail about this. But just to say
I think talk at the same pace, but you can carry some things over, really. And members are supposed to read this. And we'll get another opportunity, so it's not like you need to rush through. I think you're doing maybe too much for the time we have, but go ahead. You've got 15 minutes.
I mean, I think this was important and to explain because as I said to you, we want the extra time for explanation.
Time as well.
And it's not actually spoken about when we think about what is limiting investment and growth in capital stock and economic development in the country that can create jobs. So what I was saying about the balance of payments is that once we need to start importing, we see that our trade balance starts turning negative. And so in countries, if you look at the period, say 2007, 2008, 2009, we see South Africa's balance on the current account going towards 6%. In fact, and so there's this combination of the financial transfers linked to foreign ownership of South African shares and the short-term combined with the need for the negative amount in the trade balance. And this thing creates a real balance of payment constraint on expansion of the economy, especially more investment. Now, I won't go take a long time on this. I spoke about increased foreign ownership, but I think what's really important to realize is that ownership in South Africa in the JSE in market capitalization, almost half of it, and this is 2016, and I took this from a National Treasury document that the consultancy did for the National Treasury on South Africa's capital markets. Almost half in 2016 was owned by South African institutional investors. Things like pension funds, medical aids, etc., hedge funds, private equity funds, others. And 38% was foreign investors, and in fact most of that is also institutional investors. So the point that I make in the above is that the very high percentage of institutional investors, and it comes to almost 2/3 of the JSE market cap is held by institutional investors, foreign and South African, if we look at the estimates. It reinforces the power of the shareholder value movement and a focus of large firms on high short-term returns rather than longer-term productive investments. And so if you look at the way in which pension funds, but more hedge funds and private equity funds manage their money, they have to keep reporting, and their fund managers have to keep reporting, sometimes on a quarterly basis, higher returns, and they basically treat their portfolio as a portfolio, not as long-term productive investments to be nurtured. This graph looks at sort of what's happened in the stock exchange, the top 500. On the left, we see that 86% of the stock exchange total is actually the market capitalization of the top 50 companies. This was in 2017. And the other 14% is sort of outside of the top 50. Of that, 23 of the top 50 corporations were not cross-listed. 23 were cross-listed. In terms of market capitalization, this amounts to 66% of the JSE's market capitalization. And these include, so what's happened is that a lot of the large South African corporations with capital have actually chosen to move abroad. One reason is that we saw a lot of shifting and corporate restructuring and moving abroad just after the elections and linked to democracy, and I think there was a fear that a developmental state would tax more and want to extract more from large corporations and push them maybe in an East Asian style industrial policy to do more of the kind of investments that maybe some of them weren't willing to do. But also there was large corporate restructuring and within moves towards global chains. And many of them wanted to be part of that movement. And so if you look at the table on the left, it says South African corporations are a small part of global operations. And companies like Naspers, Richemont, BAT, Anglo American, we see sort of BAT is 18% in South Africa, but the others are sort of 10% or less. So this shift has happened as well. I'm going to skip this because I'm worried about time. And just to say that, that credit extension to the private sector has been high. It actually grew. It was 8% higher after the global financial crisis, but investment levels haven't increased concomitantly. So a lot of that money is not, that extension of credit to the private sector is not going to investment. And there's a concern that government debt is crowding out private borrowing for investment, and I say this is not true. And linked to what's been happening with finance is that we've seen the average net acquisition of financial assets by private businesses being substantially larger than the actual net capital formation. If you look at the period 2000 to 2019. So the red line is a net acquisition of financial assets, and this is by the private corporate sector, a lot of them non-financial businesses. And so what I say is this relatively large choice of acquisition of financial assets over net capital formation may indicate pressure from institutional investors and the shareholder value movement for higher short-term returns over longer term productive investments. And so this affecting the ability of the economy to industrialize and transform its structure. So we see that the structural regressions linked to inadequate industrial transformations likely to mean that technology and innovation required for South Africa's leap into 4IR will be severely constrained. This is the fourth industrial revolution. South Africa has had declining investments in manufacturing, causing capital stock to age and decline. The technology for 4IR is introduced as manufacturing and productive services grow through investment and addition of new capital stock. Learning and innovation for 4IR occurs cumulatively through applying labor to new technologies embedded in new capital stock. The new investments for 4IR platforms across sectors have to occur within value chains and throughout the economic infrastructure. Okay, thank you. I'm going to hand over to Rashad to carry on with the presentation from here. Thanks.
Rashad, how long do you think you'll need?
Well, I was allocated 12 minutes, and then there's a section there after chairperson, but I can try and do it in 4 minutes.
Oh
given
dear,
time
no. Look, I mean, now you guys are taking advantage, really. As a chair, I have to rule. You've taken on more than you can chew. I cannot do more than speak to your PBO director. And there are members who've got meetings at 5. And for reasons beyond our control, we started about 10 minutes late. So, you must leave out a section. Dumasani, you're the director, please, Otherwise, it becomes like it's too much to chew on. It's just too much. And I'm tired of raising this with PBO, really. I have to chair, and really, the norms we've established have been for years now, and we've given you lots of space, and we see you all the time. So, can you please finish in time? You'll have had by 4 o'clock 1 hour and 16 minutes. Thank you. You can leave out a section, and we will come back to that when we get another opportunity.
All right. Thank you, Chairperson. Thanks.
So go for it and finish the last section in the next 10, 12 minutes at the most. It's 15:54. All right, I'll give you 10 minutes from here.
Okay, thank you very much.
Section in 10 minutes, please.
Okay, thank you very much, Chairperson. As was noted by in the earlier section, that there are certain prerequisites for growth. Amongst these are food security, energy security, and adequate infrastructure. Food security, as the factor suggests, occurs in a society when everyone has sufficient food to eat for an active and healthy life. I'm going to skip more details in the definitions. We can measure food security through food access, food utilization, and food availability. The relationship between growth and food security is a two-way relationship. For there to be growth, and a population needs to be healthy, needs to have adequate nutrition to be productive. A healthy population places less of a burden on the healthcare system. At the same time, when there is economic growth, there is often, not always the case, improved nutrition. With regards to policy on food security, South Africa as a country has sufficient capacity to produce its own food. However, the issue over here is not the ability to supply sufficient food, but rather the inability for most of the population, or a significant share of the population, to feed itself because of inadequate or no income. And South Africa's response to this in terms of policy has been to raise incomes or provide income through social grants and through attempting employment-intensive growth. Next slide, please. Despite this, South Africa still has high levels of food insecurity. And we know at this point in time, more than 20% of households experience some level of food inadequacy. Next slide, please. COVID has obviously worsened this due to a loss of income, interruption of people's regular economic activities. Despite the state trying to step in with temporary grants, there was widespread hunger throughout the country. Next slide, please. Energy security, as the term suggests, is when a country has sufficient energy, including electricity, gas, liquid fuels, and other forms of energy to meet its current needs. This is critical for economic growth. You can't fire up a modern economy and have economic growth and development without adequate energy. But at the same time, energy needs to be available, accessible with respect to price, and as well as of a sufficient and sufficiently acceptable when it comes to the public's considerations on the environment and also on the quality. Next slide, please. Energy security in South Africa has been a major issue, and as we all know, with load shedding schedules that are quite familiar to us, and it's been probably the most severe and long-running energy challenge. And it has had a massive impact on lost potential growth, on lost incomes, and on economic development and human development as well. A lot of the factors contributing to this have been failures of government in terms of planning, in terms of management of SOEs, in terms of financing issues, as well as the commissioning of plants, as well as the procurement of new energy. Next slide, please. Energy policy in South Africa, despite having the stated goal of providing energy security over the past 15 years, has been characterized by energy policy uncertainty, significant incoherence with existing policies, and a very clear case of vested interests affecting the policies. And we looked at the various iterations of the integrated resources plan that are at times don't make economic and financial sense in terms of the energy that it has tried to prioritize, specifically still opting for or suggesting a nuclear option, despite it not being sufficiently viable with respect to the public finances and the state of the fiscus. Next slide, please. With respect to South Africa's energy policy going forward, this has been a central focus of the country's most recent economic reconstruction recovery plan, which PBO presented on about 3 weeks ago. And this is one comforting and welcome development in the policy space, given how much of a binding constraint energy security has been for growth and development. Next slide, please. Along with energy and food security, adequate economic and social infrastructure is absolutely critical for growth. You can't export goods if your ports aren't working. You can't capture the gains of the fourth industrial revolution if you don't have sufficient 4G and fiber and the likes. And so this is also quite critical. And related to this is social infrastructure with regards to education, sanitation, and water. This has been a policy priority, at least stated, for the past 27 years since democracy. And there have been some strides made in this respect. The NDP, again, tries to make the center of its policy priorities. Next slide, please. Infrastructure investment in South Africa, despite it being a central focus and a priority, has been declining, both with respect to public investment as well as private investment. The reasons for these are various. The graph over here contrasts current trends in terms of infrastructure investment, both public corporations, government, as well as private, to the NDP stated objectives. And so we're falling quite short of the NDP target, if you like. And this has a major impact on growth in this country and development. We also note that the composition of public spending has shifted in favor of goods and services and compensation of employees away from infrastructure investment. And this is, again, a concern going forward. Part of the reason for this has been very poor public sector balance sheets, both SOEs as well as general government, as well as policy uncertainty with respect to, for instance, renewable energy. We had government really dragging its feet for 3 or 4 years on renewables, preventing what was very obvious room for investment over there, as well as some policy incoherence. There are some positive developments with respect to South Africa's economic reconstruction and recovery plan, again, trying to prioritize infrastructure investment on energy, telecoms, and transport. And going forward, this will be quite critical, and remains to be seen the degree to which this is effected. Thank you very much.
So, Chair, do we still have a minute or two, or do you want us to stop there?
Chairperson, can you just...
Can you round up, please, man? We can't be mechanical about this, but, to be fair, Dumasani,
yeah.
I mean, once again, you intellectuals, right? I mean, you are technical people. I raised this before colleagues. You could spend 6 months on a paper And then when you go to an international conference at huge cost to the university or wherever you come from, how much of time do you get? 5 minutes, 10 minutes maximum. I've never got more than 10 minutes as a former academic in any international conference. And a parliamentary network where I represent this parliament, I can't recall, them giving us more than 10 minutes. So, I mean, there's no excuse really. You could have managed the time in your preparations better. So I'm unsympathetic, but can we just give you or whoever 3 minutes to summarize? Thank you.
All right, I'll give Dr. Mohammed to quickly summarize the main slides there. Just summarize, Siraj, just in 3 minutes.
Okay. Okay, thank you, Dumisani. I must apologize, Chair. I think I was the culprit for taking too much time, and I was sort of trying to explain things more.
No. Stuff you're doing is good. It's just too much for us to handle in
yes,
one
no, I apologize for that.
Thanks.
Okay, I'm not going to actually put up the slides. I'm just going to summarize what is said in the rest of the presentation, which is about the changing views on the role of government. And in this, we focused on macroeconomic policy and especially monetary and fiscal policy. And I think for this committee, the role of fiscal policy and how it's being perceived has changed. And we're seeing huge changes in the way in which the developed countries particularly are approaching the role of the state and recognizing that, especially with the global financial crisis, but more so with COVID-19, that you can't depend on the profit motive and operators in markets to deal with many of the challenges facing us, and also reinforced by the climate crisis and those kind of problems. And we're seeing the state playing a huge role, and in that there's also been a recognition that Milton Friedman and monetarism was incorrect, that the focus shouldn't be on monetary policy, and after the global financial crisis, the dependence on the use of monetary policy, the shortcomings were shown up, and that the work by many mainstream economists and what the new consensus forming about fiscal policy is that fiscal policy is effective. It doesn't crowd out the private sector. In fact, it crowds in where the state invests in dealing with people's health issues, productivity, infrastructure. And so fiscal policy is seen, and so this is in terms of providing people with money in COVID-19, spending money on infrastructure, supporting industrial development. The US is on the spur of a bipartisan agreement on a huge investment in industrial policy. Part of it is linked to them feeling that China is acting unfairly and is a threat to them and their role in the global economy, but the actual measures are very much classic and traditional industrial policy type measures, and so we're seeing that shift as well. And so just to and the other thing is that if you look at the experience of Japan, even before the global financial crisis, Europe, the US, and Japan after the global financial crisis, the fear of debt has in developing countries particularly has lifted, and the work that has shown that large debt is negative for the GDP was shown to be flawed and empirically done incorrectly, and that the large levels of government debt aren't necessarily a problem, a constraint on GDP growth and development. And here we have to take into account that this is about how effectively governments spend their money and how much waste and corruption there is, etc. But I think the overall lesson and what's happened is, to put it in the terms sort of paraphrasing Karl Polanyi, the pendulum has swung from sort of less state and the state reducing its role in the economy back to a situation where we see a larger role for the state. And my last point is that, in fact, even though a lot of these policies about liberalization have spoken about a smaller role for the state, we actually haven't seen that happening with deregulation and liberalization. And one important example is the financial sector and all the financial crisis we've had since the 1990s, the Asian financial crisis, 12 developing country financial crisis, the global financial crisis, including developed countries, etc. is that the role of the state changed to basically stopping and regulating crises from not happening and regulating capital markets to one where they didn't regulate and they cleaned up and mopped up after the crisis. And in fact, there hasn't still been proper recovery since then. So in terms of talking about the changing role of the state, I think I'll stop there. Thank you very much for the extra time. I apologize to all members for, especially for me, taking too long. And I thank you for your indulgence. Thank you very much.
No, that's fine. It's been a very good input. Thank you, all of you, Dupasani and your team. One's not questioning the quality of what you're saying or the level at which you directed it this time. It's much more user-friendly. It's just maybe too much for us to manage. Okay, so I know Zolani said he has to leave. He's got a meeting, urgent meeting, and we'll have to let him go soon. Right, so who wants to raise questions? Right, so we have Dennis there, Mr. Jutoy. Right, others? Zolani, probably before you go, maybe you want to raise something. The research staff, if they want to raise anything, the content advisor. Okay, right, go for it.
Thank you very much, Chairperson. Chair, at the outset, I want to just make the point that you mentioned to us a week or two ago that the SACP, you are helping with the organization of its centenary, which is held next month. And, unfortunately, I need to draw the attention to the PBO that the call for papers to be submitted to the SACP's centenary function expired in February of this year. So, what they've done now, presenting a paper that would be more fitted to a SACP conference than to a meeting of a parliamentary committee, it's lost its effect. It's too late. Because frankly, Chair, that's what today was. It was a very one-sided presentation of one specific set of views. Certainly I started making comprehensive notes at the beginning. I gave up after I think slide 10, because really the comparisons that were being made wasn't comparing apples with apples. You can't start by comparing countries to one another and try and extrapolate that or reduce it down, distill it down to comparing an internal within the country type of financial system. And that's exactly what was being done. Now, Chair, absolutely, exploitation must be prevented. And there's certainly a role for the state to play. No one is saying, excuse me, that the state has no role at all. But the level of state playing in the field, in the market that was being put forward by PBO, it's an opinion. It's certainly not something that we should have just as the only point of view presented to this committee. If we're going to have an opinion put forward like this, then we should at least have other people giving us other opinions, because frankly, again, the independence of the PBO is brought into question through what they've done. I mean, I made the point as well. Slide 10, look, that points exactly to the failure of President Zuma's government. You can clearly see the impact of when he took control of the state and what the state had to do to the economy then. That's exactly what you see there, is when the wrong people get hold of the state and try and wield the power that the state carries, what the effect of that is on the economy. You made the point that economic growth is not development. Well, absolutely it isn't, but it sure as hell is an indicator of development. It sure as well hell gives you the tools that you need in order to create development. It's not the only measure, it's not the only factor that must be taken into account, but it's a central part of what development is all about. There was a comment the FDI didn't materialize. Well, you need to ask the comment later. Companies, local operations have taken their businesses offshore. They've taken their core operations offshore. Well, ask yourself why. It's because of the fact that the state has started to intervene. The state has started to manipulate. There was no mention of the corruption, no mention of the lack of capacity. One of the reasons we need to finish by 5 o'clock, Chair, is because load shedding is about to start again. Where's the issues around electrical capacity? How can you talk about development when we're sitting in a situation where we are not, the state that runs the electrical supply is not able to keep up with demand. There was no mention of policy uncertainty, the impact that has, or the perception of, and it may only be a perception, but there's a perception of labor law issues in this country that prevents FDI. You didn't mention anything to do with that. And the increased costs of compliance and red tape that have come across with really a government that is trying to take over more and more functionality. Look at the issues around the small business department and the red tape that they've started to bring in, how difficult it's made people to start small businesses and to get those small businesses to thrive. Let's have a presentation, PBO rather, of how many people, how many entrepreneurs have started small businesses and the rate of failure that they're having. That would be an interesting presentation. And maybe we could have a quick survey of some of those business owners and hear why they think that they've failed. The reputational damage from state capture as well. That's a massive hurdle to development, to economic growth, both of them. The reputational growth damage has meant that any foreign direct investment that we were hoping for has been taken off the table because people are not sure that their money is going to be safe here. They're not sure who they're going to have to bribe in order to keep their business here. The opportunity cost of state capture and corruption has been massive. There's no mention of that in what is holding us back in terms of the development of our country. Chair, really, I'm furious about this presentation. I find it totally, it just left a really bad taste in my mouth. And, you know, we keep on about the role of the state and then start pointing fingers at the financial institutions. Well, take a look at what happened during the prime bubble that was felt around the world. Guess what? The banks, through their own internal regulation, had made sure that they'd implemented Basel 2 and 3, and they actually ended up, the banks on their own ended up helping us through that prime bubble, and making sure that we were insulated from the financial crisis that hit some of the other countries around this world a lot harder than it did here. Well, yeah, that's my input, Chair. I'm not in.
Yeah, next is Mr. Jutoy.
Thank you, Honorable Chair. Please indulge me with my video camera.
Yeah, no problem.
Thank you. I want to know the global financial crisis worldwide, that happened in 28. Now, according to your graphs, inequality increased under the leadership of Jacob Zuma, as the previous speaker alluded, 29 to 2018. Both definitely had an influence on that. I want to know, are there any estimates or graphs available on how the inequality levels would have looked if state capture did not take place? And how would the inequality levels have looked if we didn't have the high level of fruitless, wasteful expenditure, irregular expenditure that's ongoing, and the mismanagement and corruption? Not even talking about the effects of talks of expropriation without compensation. I mean, referring how the markets fell when that process was announced. Second last, Chair, it seems as if the high income groups, the top 10% and the top 1% are being referred to as the overspenders, when in some instances they might be involved in job creation, in wealth setting in the country. And lastly, the population growth in income groups were also not taken into account. I want to know, what is the effect of population growth in low-income households compared to high-income households? Because this is a very controversial topic. I tried to read up about it while the presentation was going on, and in most of the articles that I crossed, it was stipulated that lower income groups tend to have higher population growth. Now, obviously, that will have an impact on the inequality in the country. That's all from my side, Chair. Thank you.
Thank you. Who's
Chair.
Next? Yes. Zolani?
No, Chair. I just wanted to ask, Chair, thanks for giving me the opportunity. I wanted to ask, Chair, in appreciation of this presentation, that is it not possible that at all material times we employ a more of an organic approach to policy direction and policy perspective instead of being more academic about issues? I'm saying that, Chair, that in this presentation, there isn't a clear foregrounding and mainstreaming of the fact that we're predominantly a rural country, like all other countries in the continent. As long as that does not come quite clearly and robustly, I think that sometimes our policies will fly just above the heads of our people. That's point number one. Point number two, is there no possibility that we can begin to simplify policy so that it could also be understood as a strategic intent of the entire citizenry of the country? It mustn't be something that is only be understood only at this level by us. Because I believe that we are speaking above the heads of our people, and everything that we say seems to be flying, above their heads. I want us to begin to look at that, because one other thing, Chair, which is quite glaring in these presentations, is the fact that they are actually very brilliant presentation, and the content in them, it does sound to carry a hell of a lot of sound ideas. But I'm worried about the implementability of these things, because from year to year, we speak so good and a very good language, but my main worry is on the implementability, on how we translate this in a very efficient and effective way into implementation. Because I think what we are not getting as we would want is implementation. And I think in that way, we can easily turn a corner in a number of areas. Thank you very much, Chair. I wanted to raise that point.
Is anybody else who wants to speak? No. All right. Firstly, obviously, as a chair, I cannot stop anybody from saying whatever they want to say, as long as they stick by the norms and rules of Parliament. And there's a fairly firm framework for that. But I must say, Dennis, I don't understand what you're saying about the SACP 100th anniversary conference. Firstly, as I understand it, it's organized by the University of Witwatersrand, Wits University. They called for papers. I don't know what that has to do with what the PBO is saying, quite frankly. I mean, obviously you're out of touch with what the Communist Party thinks. So the first thing to say is that I have never heard such sound and fury from a member of this committee, signifying nothing. Actually, in the first instance, this meeting occurs, as I explained 2 weeks ago. And let me start with this. The reason I mentioned, I don't know how it came out, but I think there was a clash between the Northwest intervention meeting on a Monday and an SACP responsibility I had. And I explained that, look, it's 100th anniversary, I have to be there for that meeting. So that was the only reference I can recall, because Mondays are terrible days for most political parties. And I have tried to negotiate with the chair of that committee. Fridays are better, but I can't obviously prevail upon what the majority wants on a Monday. But as we reach local government elections date, I don't know how we're going to meet on Mondays, but that's not my call. So to come to the main point here, why are we having this meeting? As I recall it, maybe Nkululeko can help, and Esther, as I remember it, I think it was in last year's MTBPS or earlier adjustments budget, that the PBO mentioned to us what we know from the Business Day, no less, and the Financial Mail, no less, and the Financial Times, no less, all the papers of, were hardly sympathetic to the Communist Party, that the IMF and World Bank, based on what's happened with COVID, and even before that, Saraj and Dumisani and others will brief us since we don't seem to know, was edging towards saying that the state should play a more active role in the economy, particularly because of the calamity, to put it mildly, that COVID-19 has hit us with. In fact, if you look at Joe Biden, he's hardly a Communist Party member. It's a middle of the road Democratic Party, what you might define as, a fairly decent conservative liberal in this country. Not even a left liberal like Colin Eglin or Dean Smarts and Rene Talliard and people like that. So Stuart Farrow or somebody like that. Somebody in the DA's sort of spectrum in the middle there. So, what is he doing? Just to take one example. What is the British government doing under a fairly conservative, neo-right-wing, in my view, Prime Minister? So all that happened is, twice I think, Siraj in particular, but the PBO in general said that, there's a change in stance by the IMF and the World Bank about the relationship between the state and the economy. And at that stage, we couldn't deal with it in the joint committee. So we agreed. It might even be in our report. I don't recall anybody objecting to it. And even if they did, the majority will finally decide, as in any democracy in any committee in this parliament. Hopefully that will always be the case, whichever majority it is. And historically, it's been the ANC until now. But who knows, 1,000 years from now, who will be the majority in this parliament. So all that happened was we had to find a date with the NA committee, but the NA committee's got bills and it's more important for them to get the bills to us. And we can't keep running after the NA committee. And I'm not prepared to do more than I already do. So if Dennis or somebody else wants to negotiate with the NA committee, they must do so. They are free to do so. And as it happens, we had a free slot today and they are not sitting, the NA, as I explained. So all we're doing is implementing a resolution we took. Either it's in writing in the minutes, or unless I dreamt this up, I can ring Joe and check. There was a joint decision that they will brief us. So they have been asked to brief us on those views. Now, I think whether one is on the extreme right of the spectrum or extreme left, it is useful not always to have the same point of view expressed. The PBO wasn't asked to give us different perspectives on economic growth. They were asked in particular to take forward what they said then, which is one particular approach, not pretending to offer a multiplicity of approaches, but who is the reference point ultimately here? The IMF and the World Bank and the multilateral institutions, certainly not the Communist Party of South Africa, which won't agree with half of what he said, maybe, for all I know. It's a sort of like, Joe Biden-ish, IMF, World Bank-ish approach that's being set out for us, but taken a bit further by maybe an individual within PBO. And that's right, they're all intellectuals, they encourage discussion. If they're all Dumasanis, what's the whole point of having a PBO? Does Dumasani, Janchis, want to be replicated in the PBO? No, it should never happen like that. There should be a diversity of views in the PBO. So the issues that I think, Dennis, you are directing, and now I'm acting as a chair, are more directed to me as a chair and the other members, not in a PBO. They did what they were asked to do, and they did a very good job in my view. Whether I agree or disagree with them, it's neither here nor there. I need to understand what is going on, globally. If the IMF and World Bank is saying, I don't have the time, Dennis, I don't have the time to read all these documents. I'd rather get a summary from the PBO. Now, we hear repeatedly, those of you who've joined us since 2019 also, but those of us who've been in this sector since 2014, and those of us who've been around since 94 in this democracy, in this parliament, are tired of listening to National Treasury bleating on the same things when the world is changing. So yes, the PBO's job is not to tell us what to do, but to tell us what the thinking is. So very good, PBO, you did the right thing you were asked to do. You don't have to apologize for anything, but you need to answer his questions to the extent that they are relevant, and then I will share. You're not obliged to become embroiled in the political. In fact, what Mr. Ryder is doing is forcing you to enter certain narrow political terrains. He must deal with the ANC on this and so on. So on the 2008 financial crisis, I'm befuddled about what you are saying, Dennis. That's the first time the state intervened to rescue the banks. The banks didn't rescue themselves, as far as I know. I'm amazed to hear, maybe that's a view you have, maybe you should come and present an input on how the banks rescued themselves in 2008. Even the right-wing liberals say that the state, look at the millions of people who suffered in 2008. They were so bitter. If it was not for state involvement in the UK and elsewhere, how would the banks have been rescued? If it wasn't for the injection of ratepayers and taxpayers' money in the US economy now, where would Biden's program be? So basically, I think, Dennis, it's your off day, or maybe you misunderstood. They're doing what they were asked to do. The problem isn't there. The problem is us as a committee. We took that decision. Now, all I want to say is, I think as a whole, it was too much, Dumisani. I spent quite a lot of time with you, I think over 20 minutes explaining what was required. You've done a very good job, I must say, overall as a team, compared to the difficult and technical language you used the last time we had you on crypto assets and cryptocurrency and so on. And the very next day, Dennis was kind enough, because we don't all read papers all the time, to show us the disparity in what Treasury said to us about where things are going. And I think we all got it in the Standing Select Committee on Finance. So I think it is a refreshingly different approach. Now, each member can disagree, but all I can say is many of the things that you are saying is PBO is actually government policy for now. A more state-led growth part, the ERRP. This is not to say that the points Dennis makes about the ravages that debilitating corruption is rendering on us, the incapacity of the state, and I think that we have no choice, given the widening inequalities, mostly racialized, and we're sitting on a racial time bomb in this country because the prospects of growth are so limited, and the consequences are borne disproportionately by the poorer strata of all communities, whatever racial background, obviously. I was saying to somebody yesterday, colleagues, in Umsunduzi, I would say 30% of the people at every traffic light. And in my hometown, every traffic light's got people running late into night, 8 o'clock onwards and so on. If you're driving at 8, 9, 10 p.m., you will see people at the traffic lights. I mean, look at it, it's winter now. Now I ask you, what does it say about this country? We had never intended, excuse me, just 1 second. I think, Dennis, the cat is so appalled what you said, it's fleeing. So what I want to say is, if you look at the traffic lights where people are begging, 30% or so are whites, actually. That's white poverty too. It was never the aim of the ANC, as I understand it, that there should be white poverty or any poverty. So the poor whites are also the responsibility of this non-racial government. So, but the fact of the matter is, primarily, it's disproportionately African and so-called colored people who are bearing the consequences of COVID-19. And there is no way in the world, now I'm entering this terrain and I'm engaging with Dennis, no way in the world that I know of, in a country of such huge inequalities, would what we have, this racial time bomb, and it's ticking, that the private sector on its own can deliver. The state must intervene. That is the position on which this party stood for election and to which it's accountable to the electorate for. So what I'm saying is that what you are offering here, I don't see it as outlandish. It's in the news, Financial Times, nogal. I read the Financial Times. You might be impressed, Dumisani and your team. I read the Financial Times regularly, apart from its beautiful language and my differences in policy. It's quite informative of what the thinking is in the capitals of the world, the developed world in particular. So, the many of the things you are saying, would I not be right, Dumisani Saraj, are actually in the editorials of the Financial Times. It's nothing like, I mean, the Communist Party's critiques can be found on our website for those who want to see it. So I really think you've done too much. I think it's unfortunate that there aren't more members here. I'm very annoyed about this, but there's nothing I can do. I blame the NCOP for the way we managed the program at the top. But I think the fourth industrial revolution, Devasani Saraj, it has to be a separate topic. You took on to it. Then energy is a separate topic. I think we need an ongoing in Kulalepo. I need an ongoing education class. And Dennis, offline, you can propose to me a topic that the PBO must handle. The PBO will be required to talk about, you know, let's say, to exaggerate and make it hyperbolic, private sector is the panacea for all the social evils of society. Can they give us a position on that so we hear a different point of view? But that's what we've been hearing all this time in some or other form. So what I'm saying is, I really think this discussion was meant to be more like, you know, engaging with PBO on a more like technical way, understanding concepts. It's directed mostly at the newer members, but also somebody like me who doesn't understand some of these concepts and that sort of thing, rather than becoming like a polemical, inter-party political thing. So in that sense, I think maybe we should have clarified it's more a political education, information thing. It's not something necessarily that the speakers themselves agree with, though I think they do, but they don't have to agree with it. So what I think we need to do is, let me mull over this. There is a bill now that hopefully when we come back next term, I need to tell colleagues, will be voted on in the House. Unfortunately, the NA committee finished it, but they didn't take it to the House. So it's not formally referred to us, but next Tuesday we'll get an informal briefing on it, which means we can't proceed in the terms of the rules. We have to wait for them to vote before the bill is referred to us, right? So what I'm saying, my friends, is there will be times when we will have another slot. So I think we need a proper program where all the members can contribute. We break up this input also into different sections. So we say we'll have the next topic will be this, next topic that's the 3 or 4 topics. And then between now and the end of the financial year, when a slot opens up, we can slide in the various topics. Okay, over then to Zolani is going to disappear. So can we answer Mr. Mkiva's question first, and then come to the rest of us? Over to you, Devasani, and your team.
Thank you so much, Chairperson and honorable members, for the comments and the questions. It's very, very helpful. You know, quickly, just to give a sense, I think what we're trying to show here, Chairperson, is that actually there has been over the years, we've seen a lot of convergence globally into stances on the role of the state in the economy, and there's an evidence out there. It's not like we are creating one-sided story, Chairperson members, but I think we're trying to emphasize that there has been really rethinking, which is more convergence as opposed to divergence in terms of how you know, the role of the state is seen. I mean, I put on the group an article which shows the Congress in the US in the brink of signing up on passing a bill, fiscal bill, which is both parties from the Republicans and the Democrats come together to agree the importance of the role needs to be played by the state, the US state in the economy. You know, I remember one part of the article there, one member I think was saying, look, we need to create information, and private sector will actually benefit from this state fiscal spending so huge, you know, which has never been imagined before. I think Siraj did touch on it. So I think the sense that, you know, we saw you one side of the story, it's because of that's happening globally, Mr. Ryder. There is a convergence, you know. And I think this, for me, is very important because one of the commitments I've made to deal is that we need to get to a point whereby the conversations that we participate in as PBO is really largely evidence-driven. You know, we want to really ensure that when we engage in these matters, I told the team, Chairperson, that look, let's always refer to evidence. Let's always refer to evidence and so on. And you will realize in many of these points we raised, we're actually showing the committee and members that there is actually evidence that substantiates the points were raised. So it's not really a one-sided story. It's actually a side story that is happening globally. And if anything contrary that happens, there needs to be fair request from the committee to government to provide evidence that whatever policy proposed actually will work or has worked somewhere. And if it doesn't work, it boils back to a point raised by the last point on our Mikiva, that the policies are simplistic. But I think the point around that, it is important. Policies have to be simplistic. But I think that the point, which aligns with the point I'm trying to raise, Chair and members, that there has to be some sense of, sort of study that really substantiate or that provide evidence that whatever policy has been implemented, it has worked, or whatever policies proposed will work in to transform the economy, dealing with poverty and dealing with some of the social economic challenges we make. The issue around dealing with economic policy in a normative perspective, it's very difficult. And certainly we've seen it over the years. So we will continue to try and really provide members with useful information in regard, which helps them, government, hold our government into account. So it's not a one-sided approach. It's actually a view that has been demonstrated globally, where the IMF, multilateral institutions have actually, rein in on the discussion to say, look, state has to play a more important role in planning the economy and also participating role, and fiscal policy has to be part of it. And that's what we see that happening. And also, but the other point I want to really raise, it's an issue of really ensuring that, when we do some of the information that comes in is really spelled out quite clearly. We'll try to spell it out clearly, because what has happened over the times, I've now checked that sometimes members ask questions of things that we've actually raised in the presentation, saying they're not there. In particular, Mr. Ryder says we didn't talk about capacity issue. We have actually capacity, human development is an issue that we've emphasized almost throughout the presentation, but he raised and we didn't talk about it. The issue around corruption, we've spoken about the issue around, expenditure composition. We say we are emphasizing the importance of it. Even if government can spend, as long as it wastes money, it will not lead to a multiplier, a fiscal multiplier that is required in this regard. So I would plead with the committee that members should really, let us put all those things out, and because it happens quite a lot of times. We refer to issues in the presentation, and members says we didn't talk about those things. So I think Chairperson would love that to be taken into account. I think I'll leave there. I just wanted to summarize broadly. I'll leave colleagues to come in. Siraj, just come in quickly, and then another, as I said, time is quite behind us. But that's what we want to understand. Thank you so much, Chairperson. George, come in.
With your permission, Honourable Chair, can I carry on?
You don't need my permission.
Okay.
Yeah.
Thank you. Yes. I'll start with Honourable Kiva's points. The first is sort of the importance of the rural areas, and that is often an area that we do neglect and we don't speak enough about, and we don't do enough analysis on. And in a presentation like the one we did, a lot of the focus was sort of on a more macroeconomic picture that tried to sort of look at across sectors, and within that picture, agriculture and the rural areas seems to be a small role. But I think if we look at the disparities and the poverty and the possibilities, I think what people call low-hanging fruit, to improve people's lives and productivity and outputs and add value in the economy, a lot of that could happen within the rural areas. And I think that's an area that we hopefully we can talk about more in the future, and we can include in our work. So that point is really well taken. And just to add to that, I mean, the question spoke about implementable policies. I mean, what we were we weren't actually talking about policies that could be implemented. It was more sort of trying to create a sense of understanding of the South African economy, why we think there hasn't been investment, adequate investment, the role played by the state and the changing role of the states, drawing on lessons from what's happening across the world. And so, and we did make an effort to try to simplify the presentation, but also I think, as you saw from my getting caught up and not realizing how much time I was taking, I was also trying to explain things in more depth. So, and again, I apologize for that. To come to Honorable Ryder, I mean, the first point I would like to make, or not point that the request is that he mentioned making notes, and I'd actually find it very valuable if he were to share or wanted to share comments or notes with us, even outside of this meeting, and we could have a broader conversation if that's allowed. I'm happy to do that, and to say that, you know, we were coming to this not from a pro-state or anti-state or pro-market or anti-market perspective. And in fact, I mean, a lot of what my efforts are was try to show nuance in the discussion, and to also look at the structure of the economy and what's happening within the economy, and not to take sides. We do come with a specific legacy from apartheid and the role of big business that had supported apartheid. But there's been a lot of movement since '94 and shifts in very corporate social responsibility and stuff. And we may not have mentioned that, but that doesn't mean we don't recognize it. It was sort of just to understand what is happening. And in that discussion, I think it's really important that we look at things from a more nuanced and sectoral perspective, because I agree with the view that corruption, that wasteful management, that inefficiency and capacity in the state has been a problem. It has seriously affected our ability to deliver within the economy, to support infrastructure investment. The states of state-owned corporations is a serious indictment. But if one looks at what's happened across the economy in different sectors, then one can understand that not all sectors are equally affected, that many sectors, and especially finance, and this has been a global phenomenon, has managed to actually grow within this kind of an economy, and other sectors too. They've invested more. Depending on how you want to measure it, whether you use the system of national accounting, they've added more value. They haven't increased employment much, but their footprint within South Africa and even into other countries where you've got similar problems with corruption, with capacity, has grown, and they're taking that. And so I think there's a need for nuance in understanding the role of corruption. The other thing with foreign direct investment, the empirical evidence over a long period shows that foreign direct investment is attracted to opportunities for profit and growth, whether it's in mining and extractive industries or in manufacturing and others. And the fact that so much of offshoring and outsourcing went to China and other economies proves that FDI is less ideological than one would think. You know, and the efforts to actually develop businesses, mines, manufacturing enterprises, and others in places like China and elsewhere, I think shows that levels of corruption, state problems, etc., are not a problem. I mean, I'm not saying that the Chinese state didn't have good capacity and didn't provide good infrastructure, which we don't, but if you can also include India in here. India has drawn lots of FDI into productive sectors in certain states with huge levels of cronyism, nepotism, corruption, incapacity in the state. And in fact, some business, especially in mining, seem to be attracted to to those kinds of states. In economics and development economics, we talk about the resource curse, and some of that is related to how mining, where it should be giving people the opportunities by drawing on the resources and being able to take those resources and to build and reduce poverty, inequality in societies actually increases, exacerbating problems and making states even more problematic, and reducing, and they're attracted to the lack of capacity. So we're very clearly not approaching this from the kind of ideological perspective that Mr. Ryder is pointing out. In fact, a lot of what my discussion of the state is drawn from mainstream economists. And within the mainstream, you do have people on the far right and you have people on the left. And I would say that a lot of the economists that I draw on are fairly middle of the road. Some are social democrats, some are actually less social democratic. I refer to people like Lawrence Summers, Paul Krugman, Joseph Stiglitz, who may be seen to be more on the left in that. But I came into this job from teaching international finance, macroeconomics, and development, and I am more familiar with the mainstream discourse and writings than I am with what you'd call communist or socialist writings. In fact, we often don't even teach that within our universities. And so I think what we're seeing is a shift within people who are very pro-capitalist to thinking about, and this is a similar thing that Keynes spoke about in the 1930s, is the issue is, when markets run rampant and wild, how do you save capitalism from the capitalists, from the especially the financiers? And I think what we're seeing around the world is that, but also a response to a pandemic, a global financial crisis, and others, and realizing that the role of the state has to increase. And The Economist, the Financial Times, what we often see as fairly mainstream pro-finance and pro-business journalism and publications are actually saying very similar things. The views of the IMF and the World Bank may even be to the left of that in terms of the importance of the role of the state and a larger role for the state for increasing inclusive approaches to economic growth, more redistribution. And we're actually seeing, even when it comes to talking about taxes, a push for a minimum corporate tax around the world, which in South Africa, when we discussed taxes in our budget, just seemed like was something that would be impossible. And now there seems to be a move by the G7 to move on to that. In terms of Honorable Du Toit's comments, that inequality after the global financial crisis increased because of lack of employment opportunities. And no doubt the Zuma years, President Zuma years, the corruption, the wasteful expenditure, everything that happened and the undermining of state-owned corporations contributed to that. But at a macroeconomic level, I think the lack of productive investment that creates the engine for growth within an economy, across an economy, from the primary sectors, agriculture and forestry and fishing and mining and quarrying, right through to the kind of 4IR type sectors, the ITC sectors. We didn't see that kind of growth. We didn't see the investment. And as I showed in capital stock, we actually have old capital stock and declining levels of capital stock in our productive sectors, and this affects the kind of services we provided. And as I said, the levels of inequality then affect that. And we often think about corruption as a cause for poor growth, but poor growth can actually, I think, lack of investment, lack of opportunities can actually be an incentive for corruption. Especially where people may have already, be corrupt and may actually allow them to become more corrupt. We see that the levels of dependency grew in South Africa as more people became unemployed and as the population grew. And this brings me to your question on population, and that the issue of population growth and poverty is a very sensitive one, because growth and development actually is correlated with people having fewer children and sort of investing more in educating their children and others. But I wouldn't see population growth as the cause for growing inequality. I mean, I think the levels of growth in inequality have been such that there are deeper structural and systemic problems in the economy than population growth causing them. The other point I wanted to make was about skills, education, and capabilities. There's an interesting literature that looks at the deindustrialization of Britain from the 1980s and also other countries within the Western Europe that had levels of drops in manufacturing deindustrialization. I think Germany is probably one important exception to this, and can be used as a counterexample in terms of education, but also the social democratic countries of Norway, Sweden, the Scandinavian type countries are also an important counterexample. Is that it raises questions about the causation between a lack of education or poor education outcomes and skills and economic development and industrialization. And actually from that literature one gets a sense that deindustrialization actually causes poorer education and skills development outcomes. And that's something that hasn't been part of our discussion in South Africa. I think I'll stop there and see if Rashad and Sipatilo are also interested in coming in, or if Dumisani or anybody else from people have more to say, with your permission, Chair.
Yeah, of course, whoever wants to come in.
Okay, thank you. I'll give Rashad. Rashad, do you want to come in? Chairperson, we'll stop there, and I think what we will do is that some of the input, some of the comments, we'll take them with us, and we'll build on the next presentation. But I think we do take that some of the points might have been left out, but we'll take them in, and in the next discussions we'll add on this. And we really appreciate the fact that the chairperson says there will be probably more follow-up discussions where we expand the conversations. And certainly I agree with Mr. Ryder that there are a lot of broader issues that comes in and different thinkings in this regard. But I think we will be happy to be guided by a committee and we really appreciate this opportunity. I think we'll stop there. And if there are any further inputs, we will be happy to provide insight in this regard. Thank you so much, Chairperson.
Yes, thank you. We're at about 16:55 anyway. So colleagues, what we can do is ask members in the next 2 weeks or so to suggest how we break up this, call it education process with PBO, and we can obviously get some academics in and so on from a different range of thinking. But remember that the bills are coming through, so it's not something we can do immediately. Whenever we get a spare slot like we have today, then we can use it for this sort of purpose, where we don't need to call one of the entities that falls within our committee to be subjected to oversight. But our primary aim, obviously, is to hold the entities and National Treasury and SARS to account and to pass legislation and the budget. So having said that, I want to thank all for their participation, the PBO in particular, and that we will meet again next Tuesday. I think, if I'm correct, in Kulek, it's the last sitting for this quarter. Am I right?
Yes, Chair. Next week, Tuesday.
They
is the
haven't
last-
extended it by another week. Eh? There was some talk of extending it by another week, but you don't know anything about that.
No, not at all, Chair.
All right. So at this stage,
it's going to
sorry.
be in the morning, Chair. I just wanted to announce that.
Oh, good. They're going back to mornings now.
Yes, yes, Chair.
Okay. So next week we'll look at the remaining minutes, and we will look at the bill that's on an informal basis. Obviously, it's a briefing on the bill. It's still to be debated in the NA and then formally referred to the NCOP and then brought to our committee. But we can get going with the bill. We've been waiting for quite a while for it. Okay, thank you, everybody. Bye then.
Thank you, Chairperson.
Thank you, Chair. Bye.
Recording stopped.